All right. Good morning. Good morning. Good morning. How are you guys today? It's great to see you all here, waiting and ready, excited to trade. All right. It's a Monday morning. It's almost 7:30, and we're watching the morning bell here in Chicago, looking for the markets to open. Now, this is the New York Open, of course, because we are looking at the Chicago markets. Up in the upper left-hand corner, we have the S&P 500. Upper right-hand corner, we have the Dow. Bottom right-hand corner, we have the NASDAQ 100. Bottom left corner, we have the Russell 2000. And they're the ones we just kind of like to watch on the morning bell. But as you saw out front, we have the little marquee on the little thumbnail for YouTube. We had a thing that said we're going to look at the skew, right? We're going to test the skew of the put options. What do I mean by that? Last week, we learned what the skew was, right, from the Chicago Board of Trade. We looked at that slide. If you weren't available and weren't able to see that video presentation, go back and look at Friday's video, and you will learn about the skew and the VIX, and you'll learn and understand how they work. And we're going to apply the skew and the VIX to what we're doing here in this market. If the VIX is high, we don't want to be trading sold options, right? We don't want to be doing neutral option strategies. We want to be doing strategies that will make money when the market runs. When the VIX is low and volatility is low, that's a good time to be putting on these sold options. We've been doing a lot of wild eye, crazy eye, iron butterflies. Speaking of wild eye, crazy eye, iron butterflies, Pit News Magazine is coming out today. Today is the first Monday of the month, and that's when Pit News Magazine comes out. And we've been doing a lot of work this week, or this month. This has been the month of wild eye, crazy eye, iron butterfly strategies, and we've been testing and doing a lot of different stuff. And this month, we're wrapping that all up into Pit News Magazine, and there's a big summary article about all the work we've done in Pit News Magazine, and that's coming out today. So look forward to that for all of you who have Pit News Magazine. For those of you who don't have Pit News Magazine, jump on over to pitnews.com. It's only $1 for 3 months. You get 3 issues for $1, and then it's $49 for an entire year after that. But you get to listen to the articles, you get to read the articles, and very many times we have videos that go along with the articles. But what we do is we wrap up all of the stuff that we're doing here in this Pit News Magazine, all the stuff we're doing here on YouTube, all the testing and all the examples and all the trading strategies and everything that we practice and trade here, we wrap up and put them into Pit News Magazine so you can understand and have all the research there published for you. So go get Pit News Magazine, join us. You can have it 3 months for $1. If you don't like it at the end of the 3 months, just cancel. No harm, no foul. You get three months to try it out for $1. And then if you like it, which I'm sure you will, everybody does, and then it's only $49 for 1 year after that. You can scan that little code with your cell phone, hold it up there. It'll take you over to Pit News Magazine, or you can go to pitnews.com. All right, let's get rocking and rolling here. Very excited. Maybe in a few minutes, I'll pull up the Pit News Magazine issue and let you look through it a little bit. But for now, let's watch these markets break open. What we need to do, though, is we need to test the put skew. All right. Now we talked about the option skew, and that leads us down a very deep tunnel. All right, in our rabbit hole. So there's a very deep tunnel of the put skew, and we need to test that. All right, with our wild eye, crazy eye, iron butterfly. So we're just going to continue working with the wild eye, crazy eye, iron butterfly because it's been a wonderful strategy for us, and so we're going to continue putting those on. But we have to check and see and run some more tests, and we're going to test the put skew. Since we learned about that on Friday, we need to now apply it to our trading strategy. And again, as I say, it takes us down a very deep road or a very deep tunnel. And we got lots of things we can talk about when it comes to skew and lots of different strategies. I want to talk to you about some new strategies. So this week, we're going to learn some new strategies. So make sure you come and join us for the rest of the week because I'm going to teach you about married puts. And we're going to talk about legging in and legging out of strategies. We're going to do all kinds of really neat, fun stuff with options because now we've got some additional information that we learned, and we can use that and apply that to our trading. So we're going to do that today. We're going to do a little bit of applying some of that knowledge to our market. So we're going to test some things with our wild, crazy butterfly strategy. All right, we need to test the put skew. I'm going to show you how that works. But here in the first beginning, the bell just opened, and that's why the markets are taking off and running. We are looking at something unique here today. We are looking at range bar charts with Heiken Ashi, our Heiken Ashi range bar charts. Now, up in the upper right-hand corner, you can see this is the Dow, and we get the range bar 6. And the Dow's been performing very well for us lately. So we're going to see if that's going to continue. Looking for an opportunity to take a long position or short position. We'll let it wander around here for a little bit, breaking out of this morning bell. We got to go look at the news because we got a news report coming out here soon too. The Russell kind of falling there with a range bar 6 as well on the Heiken Ashi. There's a range bar, Heiken Ashi bar. This is the NASDAQ 100. Also, this is also a micro mini though. It's 10 times smaller than the Dow and the Russell. All right, so these are mini contracts. This one here is a micro mini contract, and it is a range 20. This market moves a little bit faster, so we slowed it down and calmed it down a little bit so that we can trade it a little without taking such big risks. And then up in the upper left-hand corner, we have the 2-minute chart on the S&P 500. And the reason we are looking at the 2-minute chart on the S&P 500 is because we are going to put on a wild eye, crazy eye, iron butterfly. All right. I kind of want to do that first thing. I want to kind of get that on there as soon as we can. I want it to come down here and drop down a little bit, see if we can't get it to come down to the VWAP. As soon as it touches that VWAP, we're going to put this thing on. So as the market falls and bounces around a little bit in here, you can see we also got the bulls and bears turned on. I thought it'd be fun to watch the bulls and bears today. You can see it bouncing back and forth across the VWAP here on the Dow. The purple arrows are the crossing of the VWAP. The red arrows are the indication that the market is breaking into a Fibonacci trend. All right, so that's what the red arrows are indicating right now. We got a Fibonacci tool turned on. It's called the Bulls and Bears. It's a proprietary indicator in track and trade, and it's what turns the price bars red, yellow, and green, and it's also what throws these Fibonacci arrows, indicating that the market is changing from bullish to bearish and breaking out of the Fibonacci sweet spot. All right, so when it's yellow, that's why it's neutral. So it's in the neutral zone, and then when it goes green, it starts to go into the bullish trend. When it goes red, it's going into a bearish trend. And that's what those arrows are telling you. You can use those as buy-sell signals if you want to, but that's not generally what we consider them. We generally consider them to be bullish, bearish arrows. And I've got bullish, bearish arrows turned on. You can set them on in the bulls and bears. Let me show you. We can come over here to our preferences for the bulls and bears, and here's our preferences right here. I'm using the progressive formula in here. I'm also using a sensitivity of 72 on the slider, and I don't have the blue lights on. We turn those on if you would like. Those are your trailing stop locations. But I have arrows on all color changes turned on. You see that in the filters down here? If I turn that off, you just get one buy signal for every sell signal. But I like to turn that on because especially when you're day trading with it, you can then come in and you can see where it's breaking out of the Fibonacci neutral zone or the Fibonacci sweet spot each time, even if it does it multiple times. Like here on the Russell, you can see we have a sell, sell, sell because it kept going back into the Fibonacci sweet spot before the market opened. As soon as the market opened, it went through the neutral zone, it broke out, went to the bearish side. All right, so that's kind of how that's working. And we're going to use the put skew here. I'm not sure if we'll be able to get to it today, but we'll probably get to it tomorrow. And we're going to use put skew on how to trade for a longer term trade, so we can take longer term positions and use the put as insurance. We're going to do a married put. All right, we're going to get married. Us and puts, we're going to marry them. So go out and get your engagement ring because we're going to get married tomorrow with a married put. All right, so we're going to do that in the futures market. We'll also go over and do the stock market. I need to pull up our spreadsheet and talk a little bit about our spreadsheet and talk about what happened with our options last week. We had I had a good conversation with Bruce, and he put on the wild eye, crazy eye, iron butterfly, and let's see, is that working? There we go. All right. So if you guys want to pop in and say hello, we got a bunch of people watching the class already this morning. So go ahead and say hello, and we'll make you famous. And I was talking to Bruce yesterday, and I was mentioning that conversation I had with Bruce. Look at that. This market's coming back up, driving all the way back up to the VWAP. Look how it went right back up there and touched it like a train on rails. Right there. Boom. Touched the VWAP. So it came down here, broke through the neutral zone. You can see it went through the Fibonacci sweet spot, neutral zone, broke out of the neutral zone, went right back up to the VWAP. We're getting a little bit of a pullback in there, a little flag formation right there. That's what that is. And so now the market's starting to rally once again. All right, so Bruce was actually the one I was talking to. He said he put the Wild Eye, Crazy Eye, Iron Condor, Iron Butterfly on Friday, and he said he did well. And I did the same. He said he put the same one on that we did in class, and so the one in class is the one I put on. And it did well, and I think I got it here for us. We can take a look at it. And when the market flushed, if you remember on Friday, the market flushed quite hard. I added another insurance policy or another strangle. I put another strangle on right at the bottom. I was pretty lucky. I caught it right at the very bottom, and it turned and came back up. But it ended up. This was the. Oh, that's not the right one. That was what I did with that was our stock closeout. I need to talk about that too. Here's the one for. Yeah, here's the one we got. Here's the Wild Eye, Crazy Eye, Iron Butterfly. Right there. That's how we closed that one out on Friday. See this market? We put it on right here. Remember, we put it on right. Can I draw on this thing? Oh, market. We put it on right here, right when it crossed the VWAP. And then this market just flushed all the way down. And so this was showing a big loss. And so right here, I picked it like right here. I put on another insurance policy, and the market turned and rallied all the way back up. And I took it off right here when it hit the VWAP. And this is how it turned out. So you can see yesterday we ended up with, our Friday, we ended up with $915 on those two trades. So that was nice. We put that on here in class. And then I added that later. And when it came back to the VWAP before, and then it went into power hour and just blew right past that VWAP and kept right on going. But I had taken the positions off by then. And so that's how we turned out. All right. So that's what happened yesterday or on Friday, $915. And we're going to put one of those on again today. But we're going to do a little skew test. We need to test the skew. So let me show you just real quick. Let's pull this spreadsheet up. So let me come in here. We're going to pull up the spreadsheet. And how come it's not pulling up? Come on, spreadsheet. There we go. Now I'll just pull up twice. Okay, here's the spreadsheet. Oh, let's come back to May. So here's May. Here's how we closed out May. And I have the 915 right here on the options. You can see I put that in there. Closed out our Wild Eye 30-minute. Can you see that? Yeah, you can see it. Closed out our Wild Eye 30-minute before the close of New York market. I added a second insurance policy as the market tanked, which added another $300 to the total profit at the market rebound, all the way back to darn near max profit, as luck would have it. So we did pretty good on that one. We didn't do any day trading, so that was left empty. And then we did close out. I wanted to close out the month and start June completely fresh and new. So I closed out all of my stock options we had on in our class portfolio. And most of those were short positions that we took, and we closed out $2,265. And you can see which ones we closed those out on. It was right here. All right, so we closed those out. You can see we closed out a $400 profit on the Qs. We closed out, and that was a bot. We bought two. Those were all puts. It doesn't say it in here. On the closed position, it doesn't say. I don't have that. I guess I don't have that turned on. These were all puts, every single one of them. I think every single one of them was a put. So we made $442 on our Q put. We made $1,200 on our Microsoft put. We made $660 on our Meta put. We made $100 on our SPY put. And then BITO, that was actually a long position, which was Bitcoin. And we lost $22 on Bitcoin. All right, so that was how we closed out last week. We got this nice little butterfly pattern in here on the S&P on the daily chart, as I showed you. And the reason we were taking short positions is because off that right wing of a butterfly is generally bearish. And of course, the blue lights were corresponding up there with that on the bulls and bears, saying that this market was going to have a blow off. So at this point, we're just looking to see how far it's blowing off. Now, it turned and rallied again towards the end of the day. So I'm not sure. And it looks like we need to go look and see what it's doing today. From a longer term standpoint, it's not really doing anything. Let's double check the S&P right now, see the pattern. So we're getting a little bit of a rally right now. So we got our pullback. It touched the 50-period moving average. on Friday, and now it's starting to rally today. So today we're getting a good up day. The question is on this, is it going to just turn? Is it going to be an ABC pattern where it just goes A, B, C? Oh, Lan, you missed it. Grab that, put it back up there where it belongs. Right there. Is it just going to be an ABC and we're going to get a projection out into expiration? Or is it going to just be a little pop-up and then turn and fall and flush one more time and come down and test these areas of support down here? That's the 100-period moving average. That is the 200-period moving average. If we come in here with our Fibonacci ruler and just draw that across there, you can see that we're up into the Fibonacci extensions, but you can see the yellow zone right there. The yellow went right through the Fibonacci sweet spot. That's why that's yellow bars. Went through the Fibonacci sweet spot and then rallied out the top of the sweet spot up to the projection level. Speaking of that, there is another great article in Pitt News Magazine this month about how to use Fibonacci and how to make these projections off of that yellow zone on the Fibonacci sweet spot of the bulls and bears. It's a great article. It's a little secret that a lot of people don't use when it comes to the Fibonacci ruler. But what we can also do with the Fibonacci ruler, and we talk about this in the article, is you can bring this up and put 61.8 on your high of the drive 1 pattern. So that's if this is drive 1 of your new Elliott wave, you put the 61.8 projection at the top of that wave, and then your next projection or your entire wave pattern, 3-drive pattern, for those of you who know what that is, drive 1, drive 2, going to get a pullback, and then drive 3 would take you to this B point right here. And if you go back and look at 10,852,686,714 charts, you'll see that it does it all the time. So you just need to go and get comfortable with it. Look at some historical past charts, run this thing across these different things, and you're going to be blown away at how often it does that. And this is all documented in the Pitt News Magazine for this month. You can go look at Fibonacci, and it's going to show you how to do some of these Fibonacci projections. All right, so that's what we're looking at right now. And this is actually a bullish signal. As the market is bouncing off of this 50-period moving average, we got a yellow bar right here. We'll have to wait and see how it closes out, but that's bullish. That says that this market wants to go long and probably off of this pullback like that and start to shoot up once again. So be mindful of that. Our S&P is looking bullish. We did look at the VIX on Friday, and the VIX is starting to increase in value, and so that means that the volatility is rising. So keep that in mind. You can see here we've got the S&P is taking off and going. It never did come back to our volume weighted average price. It never did come back to VWAP, staying above VWAP. There's another strategy, the married put strategy, that I would like to put on in that situation, but I haven't taught it to you yet, and we're not going to learn that till tomorrow, so we can't put it on today. I want to test skew volatility on our wild eye crazy eye. So let's give it one more second, see if it's not going to pull back just a little bit, and we'll put that on. We could go put it on right now. It's kind of pulling back. Watching for an opportunity to put on a position in one of these markets, just a day trade. We'll see if we can't get a day trade off. Got a couple people in here saying hi. We got Matt saying hello. It's great to see you, Matt. Swing by. How's things going for you? Did you have a good weekend? Are you in this Russell, Matt? Have you got a short position on this Russell? It's doing nice, dropping a little bit. Markets are pretty quiet. 15 minutes, we got a news report coming out. So let's come in here and pull up our news report and look at the economic news. I'm going to show you something here. This is the economic news. This is the economic calendar. This is what moves a market. We know that the fundamental nature of the markets drive the long-term trends, and the technical analysis drives the short-term trends. Technical analysis is really just the setups and triggers for a long-term fundamental move, right? So we know that the fundamental nature of markets, which is a lot of these driven by these news reports, is what drives the long-term trends. But we need to know when is the right time to get into these markets. So that's why we look for setups and triggers to help us identify times when it's time to get in. All right, we got the S&P Global Manufacturing PMI final coming in at 745. So that's coming in right now, 51.3. Forecast is 50.9. 51.3 was the actual. Let's go see what that does to the market, if it does anything at all. It's a level 2. So it did sweep back and forth a little bit, not changing much of anything in here so far. Looks like the NASDAQ's getting a little rally out of it. We could come in here and see if we want to put on a long position on the NASDAQ as it breaks higher. We'll put in just a quick stop in here just in case it doesn't want to continue, just to protect ourselves to the downside. Because it looks like the Russell's flushing on that information, on that news, and so is the Dow. But the NASDAQ's kind of trying to pop higher. Not real confident. If these two are flushing, not real confident the NASDAQ's going to keep going. So we get that stop in there, and yeah, it just stopped us out. It didn't do us any good. Doesn't mean it won't continue. It just didn't take off and run hard. In fact, it's trying to break higher again. Let's try one more time. We're going to stick that in there and drop that right underneath. That's a little flag formation right there. We're going to see if it wants to push past that flag. It doesn't want to do it. Everything else is flushing. So that was look, it's just going. Now it's trying to go. So twice it failed. Twice, two shots. We'll wait for another one. You don't need to sit there and go back and forth, jumping in and out of the market. If you give it 2 shots and it doesn't work, you could try 3. 3 strikes, you're out. But then you don't want to be out. We just take a small loss on it and wait for another opportunity. It's obviously not bursting, and we need a bursting market for us to get in. We want a market that's moving parabolic, and that obviously proved to us that it wasn't. So we're not going to play with that one again. We're going to wait and see if something else wants to move for us. If it'll move, we would get in after it moved and made one more pullback. Right now, it's just going sideways. I can't decide what to do either. We got 10 minutes until we got another news report. We'll wait and kind of trade that, and then we'll put on our iron butterfly. We'll wait for this news report to come by, see what it does to our S&P 500, which is just going neutral right now. See what that PMI does. Let me show you what we've got going here. We got the ISM Manufacturing Index. What the heck is that? That is the Institute for Supply Management Purchasing Managers Index. Institute of Supply Management's Purchasing Managers Index. All right, if we click on it, it'll open that up and give you a little bit of details in here. All right, so the Purchasing Managers Index in March was the highest peak, and then it dropped a little bit here in April, and now we're going back into June. So we're going to look and see what it's going to do in June, see if it's going to rise or fall. And so that's the Purchasing Managers Index. All right, now if you don't know, how do you do that? How do you know what that stuff is? Obviously, you've looked at that before and knew what it was. I actually had to look it up. I knew what PMI stands for, Purchasing Managers Index, but I wasn't sure couldn't remember what ISM stood for. That's the Institute of Supply Management. How did I know that? I went over here to this little program right here. It's called Perplexity. Now, I know some of you have heard of that company called Google, and a lot of times you might, if you need to know something, you'll Google it. Well, Google, in my opinion, is a rotten search engine. I know it's the best that's out there, but it ain't the best that's out there anymore. You got Perplexity, perplexity.ai. All right, this is artificial intelligence search engine. Now it really just searches Google. That's all it does, but it searches Google for you. So have the auto AI, and it's free. Just go over to perplexity.ai, and you come in here and you say, I want a new search, and you say, what is the Purchasing Managers Index? So you just say, what is the ISM Manufacturing PMI? So I don't know what that is. What do those acronyms mean? And you hit that, and it'll go out there and it'll search Google for you. You don't have to go to Google. You don't have to look at all the ads. You don't have to sit there and search down through all the things and go try and find a link to a website that's going to explain it to you. This little program is going to go right out there and find it for you, and it's going to tell you, and it's going to give you the answer. It's going to search Google, and it's going to even tell you where it found it. It found it right here on Corporate Finance Institute, and it found it right here on US ISM Manufacturing PMI Monthly Trends Charts. And then it'll give you a little bit more information, and it tells you all here where it found it. So these are all of your searches, and then it went and looked at all those searches that came up in Google, summarized them for you, and gave you a nice little report. The ISM Manufacturing Purchase PMI, or Purchasing Managers Index, which is going to ring here in about 9 minutes, is a monthly economic indicator that measures the prevailing direction of economic trends in the U.S. manufacturing sector. It is published by the Institute of Supply Management, which is why they call it the ISM, and is based on a survey of purchasing and supply executives across over 400 manufacturing firms representing 20 different industries. And how do I know that? Because I went and looked it up right here for you, and I looked it up right here for you, and that's what our summary is. And then it gives you another little indicator. Oh, I looked it up right here for you. I looked it up right here for you. So that's why you're never going to use Google again. Actually, you are using Google. It's just somebody is searching Google for you, which is the AI system. That's pretty cool. So I just wanted to show you that. And that's going to help you with these things so you can have a better way. Oh, look at what it's doing now. It's flushing like a toilet. It's coming down here. Now it's just passing. We wanted to put that on right there, but I don't want to put it on. I don't want to put on a neutral option strategy. Oh my goodness, look at that NASDAQ. We were trying to go long right here on that rally, thinking, hey, maybe this thing wants to go up, right? It went sideways, and then, man alive, look at it flush. Came right down here, broke out of that Fibonacci sweet spot, which is told to us by these arrows, and down that thing. Oh my gosh, look at it go all the way back down to the VWAP. Holy smokeroonies, that was a big, beautiful run while we were off looking at something else. That thing smoked it. Look at that. Wow. Flat tops all the way down. It just flushed like a toilet. Oh, just swirly, swirly, swirl. Down it goes. Where was I? We were reading about the Purchasing Managers Index. So good thing we didn't put on our neutral option strategy, because it would be getting its hiney handed to it right now. We just kind of want to wait for this thing to settle down here. Oh, look, we're getting a little bit of a rebound here on the Dow as it's coming back up, testing some of these areas of resistance and trying to flush once again. We got that little whipsaw in there. Let's see what happens. See if it wants to. It's getting a little excited here before this news event. Boy, look at the NASDAQ went right back down to the VWAP, and it's just riding along the VWAP. It's like, what am I going to do? I'm at the VWAP. Should I go down some more, or should I just wait right here? We got 5 minutes to our next news report, and it's a red one, so it should be exciting. It should move the market. So the red ones are the ones that move the markets the best, and then the dark black ones. You can see that I'm here on UTC 6. You're going to have to make an adjustment for your time frame, and then I've got it set to 2 impact. So I don't have any 1 impacts in here. They don't move the market enough to make it worthwhile. But you can see here at 8 o'clock, you get all of these ISM manufacturing, new orders, spending, manufacturing prices, and then we got the 3-month bill auction, 6-month bill auction. Those don't move the market that much, so we take those out. And these are just the most important ones. If you want to just see the red ones, you can do that too in here. And all we can do is just see all the red important ones, the ones that are going to really move the market. Tomorrow we got one at 8 o'clock, dude. The JOLTS job openings. So tomorrow at 8 o'clock, another one that's going to be really good, market mover. And then on Wednesday, we have another really good market mover at 8 o'clock, ISM Services PMI. Again, this is another, this is Services Purchasing Managers Index. Today is manufacturing. And then we got non-farm payroll coming out on Friday at 6:30 in the morning. That'll move the market. That always moves the market. And the unemployment rate both coming out at 6:30. So that's going to be a really exciting market moving day. And then Wednesday next week, whoa, look at that thing. The Fed's going to come out and make an interest rate decision. Let's not forget that one. That's going to be one nasty day, that thing. And we're going to, by then, next Wednesday, we'll be talking about the married put. So we can trade this thing. I'll show you how that works. So we're going to come in here and put this back to a 2 impact and move it back out of the way. All right. And while we wait here 1 more minute, we're going to see what's happening here. Look how it bounced off. The NASDAQ bounced off that VWAP. It started to rally again, pulled back up. What's it going to do? Everything's just waiting. Everything's waiting. So I have this spreadsheet, and you guys have seen this spreadsheet a number of times. And this is how it came out on May. This is, of course, April. This is our April trades. And then this is our March trades. This is February. This is January. And this is all, experimental testing, trading stuff that we are doing here in class. This is how we track our class. So trading is not all about just trading. You have to also track your trades. And so that's what we do in the spreadsheet. So we track our trades, and I show you that too. So that's all a teaching lesson. It's a lesson on how to track your trades and look and see how you're doing over time. And I've got this wonderful little spreadsheet: January, February, March, April, May, June, all the way into June. And June, you can see we're just starting out. We're empty. We have nothing in here. We're starting out in June with a brand new, fresh month. And we take all of our totals and numbers and move them from June. You can see our totals up here. So far this year, we're up $38,133 on our trading. And May, you can see we closed out May at $12,465. And we bring that total over into June. And you can have this spreadsheet. That's the point that I'm trying to make here. This spreadsheet is free. You can have it. All you have to do is subscribe to Pitt News Magazine. Of course, that costs you $1. And for those of you guys who are already subscribed, when you get your email, which will come out today, this afternoon, it will be a link to the new version that's all built out and ready to go for June. That is in the email. So there will be a link to it in the email, and you can have the new spreadsheet with your Pitt News Magazine subscription. I've got all that work done for you, getting your new spreadsheet ready to track your trades. All right, look, we're getting a bounce, a rebound here just before the news event. It's trying to rally just a little bit here, pulling back, giving us a nice little Fibonacci bow tie. Those of you who know what a bow tie is, that is where we have a low point right here. And the market going to use that as an area of resistance. So it goes up. So here's the bow tie. All right. You got the low, went up, created a high, broke down past the previous low, went down, created a low. And then it comes back and tries to go right back to the Fibonacci low point right there. And we tie it off just like that. And that's why we call that a Fibonacci bow tie. All right. Helps you identify where markets are going to go and gives you an idea of a roadmap of what you can expect. Okay. Doesn't mean it has to go all the way back there, but oftentimes it goes right back and touches that area of support right there. So support becomes resistance. And sometimes it'll break past that a little bit before it turns and becomes a new bow tie, right? And then that becomes a new bow tie, which we can then say, okay, we got a low point right here. And we're going to anticipate that this market's going to go back up like this. It's going to go to that bow tie point. So we're going to come back up here. How high is it going to go? Up into these regions where we got these moving averages. And then we'll expect to come down like that, go back up, create a new bow tie, and tie off that bow tie. All right. As long as the market's going through bow ties, it's very tradable. As soon as it's not making bow ties and it's just going kind of wandering back and breaks that pattern, then you want to kind of sit on your hands, sit around and wait for it to make new bow ties. All right. So that's how that works. All right. It's just a way of helping us kind of predict the future, right? That's what we're doing when we're trading. We're trying to predict the future. And those who get good at predicting the future make more money than those who are bad at predicting the future. And that's what technical analysis is all about. It's working to help us identify entry points, resistance points, support points, and trending markets, where they're going to trend from one resistance to the next level or from one support to the next level. And that's what trading's all about. And then trying to get in there and say, well, I'm going to ride it to the next support or resistance level. And it's really, that's all there is to it. That's what we're doing here. And of course, we got these fundamental events that come along and make the markets move for us. So we're going to see what happens when this news event comes out. All right. Where is my news report? Here it is. Okay, we got about, how much time we got? 32 seconds, and that's going to come out. Let's see what it does to the market. We're going to watch the Dow here. Well, we could try and kind of slide that over there, and we could maybe see both the Dow and the Russell and the S&P. We're going to cover up the NASDAQ so we can watch these other three markets. We're going to watch and see what this thing does. 8 seconds. 7, 6, 5, 4, 3, 2, 1. Okay, let's see what it does. Boom, 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 boom. Look at it. What's it doing? What's it doing? Oh, it's moving so fast the computer can't keep up with it. Look at it go. Wow, that's ripping around. Let's see. Where'd my event go? What are they going to tell us? ISM manufacturing new orders reported at 54.4. Consensus was 49. So that should be bullish. They're buying. They bought stuff, right? 51, 49 manufacturing employment. So it's up. I think up is good on this. Look at the Dow flushing though. Wasn't good enough. I don't know. They wanted to be 48.5 and it went to 53. 51. 48.5 was the consensus. Forecast was 49. It's a 40.51. So you'd think that would be bullish. You never know, though. Well, look at the S&P. It's taken off. It's shooting up like a rocket ship. It's right back at the VWAP. You know what? I think I'm going to put on my wild eye, crazy eye, iron butterfly right here, right now, right while the implied volatility is out of this world. So let's come in here. I'm going to come down to, let's go down to 4 days. 4 days. Yeah, let's do that one. Good volume, good open interest. Let's buy those. Okay, we're going to buy those. I'm going to put them on one. I shouldn't have done it with a market, or I don't know what kind of fill I got on that. Let's go do the 0 days now. And we're going to sell these. I'm going to do that with a limit order. So we're going to sell them. We got to go to the bid. 1875. Ooh, it's going to get ugly. Oh, 1875, 1820. It's moving on me. 18, 15, 18, 19. I'm chasing it now. Let's just see if we can get in there. 18, 19. Did we get him? We got him. All right. So now we got him right there at the money. Now we got to go in and we're going to test. We're going to run a test. And we're going to put some puts on here. And we're going to go back out to 7 days. Or was it 7? No, 4 days. And I'm going to go out. Let's see if we want to. Let's buy one of these. We want to do one out, or let's just do one out. We'll test 2 out tomorrow. So we're going to buy one of these. What are you doing, Lan? I am buying additional insurance because I want to see the put spread on this thing. I wonder if I can 56.25. Let's just 56. Place my order, see if I can get those on. Come on, get them on there for me. I want to buy that one and buy this one. 58. I want to buy them. 58. Place order. There we go. All right. So I just put on extra insurance. That's really all I wanted to do. I just wanted to get some extra insurance on there because I want to see what the put spread was, or the put skew. So we got 3 insurance policies unnecessarily, of course, but we are in a demo account, and that's what we do in demo accounts. We test stuff. All right. So we're going to test this wild eye, crazy eye, iron butterfly. And I've got 2 extra insurance policies. And the reason I'm doing that is because I want to see the difference between the one that's at the money and one that's out of the money. And while I'm at it, heck, why not? We are testing, right? Let's test the difference. Let's put on one more set. Let's come out here and we're going to buy this one and we're going to buy this one. Let's do that. 56.75, 56.75. Let's see if it'll take it. You're going to have to pay more for it, Lan. Oh, it got him. All right. All right. So we've got that. And now we can come over to our positions. And now I have lots of insurance. All right. So we have 4 insurance policies. That's okay. Or 3 insurance policies. 1, 2, 3. But we actually have 1, 2, 3, 4, 5. 5 insurance policies we're testing. These are all puts because I want to see the put skew, because the normal one is the ones we sold, right? So we sold this one and we're collecting on this one a cost basis of $975. And then we've got our 4 days till expiration, and they're all 4 days. So we've got the theta decay on them is all set to 4 days for all of our put options. Now I want to see the difference towards the end of the day. Which one of these would have been the better put option to have put on with our 0 days till expiration And we have one in here that's right at the same price. So we put one right on top of it, right? That's why we did the wild eye, crazy eye. So that's the 4 days till expiration insurance policy at the money. That's our hedge against the market going crazy, going one direction or the other. It's our protection. And then the other two are just further out hedges. So kind of like what you might see. Well, it's not like what you'd see with anything other than what we're trying to do is we're trying to test the skew of the options. Put options have a skew on them. All right. And generally, the put option will either increase or decrease greater value than the call option. And it's usually not in your favor. And so I want to see by moving out and buying different put options at different levels if we can't find a level that might match those up more cleanly. And if we can't find it here within these 4 put options, we may have to do more testing. We're going to do it again tomorrow. But we're going to, with the skew of the options, we have to figure out which one matches up with our long call better, our long call insurance policy. See, we have a long call buy call right there. See that one? We bought that, and it's $25. It's actually losing $50. But look, we're making $25 on the put, but we're not making $50 on the put. Are we making $50 on the put anywhere? Here's one that a put that's we sold that's making 27. Here's one that's making 37. Here's one that's making 12, losing 12. These kind of seem to be more matched down here. Which one are these? These are the ones that's further away from the market. Look at that. So these that are further away from the market, is that what that is? What price is that? That's the 53.10 and the 52.90. Oh, look. It's losing more. Yeah, at the money. That's the ones we're making money on. See the put skew? It's off by $25. Let's go see what let's go look at last. Now that one's right on 25. Well, it's still off. This one here is 75. So the puts are making money. This one here is the one that's the traditional. This is the one we generally do right here. 4 days, and they're right at the money. Same price, 53.53. So that's our wild eye, crazy eye, iron butterfly, the first two. These are additional insurance policies that we added on to see which one might be better. And it's looking to me, look, this one here is losing 75 while this one's making 75. And our traditional standard one is losing $100. But look at the skew difference. Look at the difference between the put and the call. All right, so that put is 75.25. Which one would be closer to 25? It would be this one way out here. So what is that one? That's the 53.10. 53.10 is this one. So our 53.10 is actually the one that's doing better for us. So by putting it out of the money, it's actually doing better for us than the one that's at the money and in the money. The in the money option, see this one here, the skew on that one? This put option is exactly the same distance away from the at the money, but it's because the market's moving in that direction. But we've got one that's making 62.50 and one that's making 12.50. But we have to compare all of these put options against the call. That's what we're really doing because we bought the call, and the call is not increasing. The market's moving up, so the call should be increasing. But the option, the put option, is losing more than the call is gaining, and that's the put skew. See, we're losing 75 on the put, but we're making only 25 on the call. So you would think, well, where should we put the put option to make it so it's making the same as we're losing so we can keep those equal? Well, this put option that we sold, oh, that's the sold. This put option that we bought is losing 25. This one's losing 50. That one right there looks like the one that's matching up. These are actually making money, both of them. And they're the ones that are farther out of the money. Oh, look, see the market's changing direction now. So our bought put is making 75. Now this is last. If we come up here and just look at the bid ask, it's going to change a little bit more radically. So the put option, which one's making the most money? It's this one here. That one that's way out of the money up there. That's the 53.10. So the 53.10 up here. is the one that's making the most money. Let's see if we can put those on the other side. Let's change the text. Can't see it. It's being blocked by the text. Oh, you guys can't see that. Got it. Let me come over here and move myself over to a different location. And let's see, where can you, right there. All right, see what's going on over here? I'm watching the prices of these options. I want to change the options so that, let's go into our preferences and show text on the left side. Let's turn that off. All right, so now text on the right side. So we can see this is the 5310. That's down here. See, 5310. This is very important research we're doing here. 5310. So the 5310 is making 85, 75. It's the 100. It's the one it's out of the money. That's an out of the money option. And see this buy call right here. See this buy call? That one's at the money. That's the at the money buy call, and it's losing $75. This 2 strikes away from the money, out of the money, is losing or is making the same amount of money as the one that's at the money is losing. So that's actually what we're looking for. That's the matchup we're trying to find. That's the skew that we're looking for. Now, of course, this is just right out of the gate. So over time, over the next couple of hours, and I can leave this on here all day. And then I'm going to look at this put skew, and I'm going to find out which one matches up to our long call better. Which one of these puts is the one we should be using when we put on this long wild eye, crazy eye, iron butterfly? Because they don't match up when you do them both at the money, because there's a put skew in there. And so what happens is either the put will lose a lot more money than the call will make, or vice versa. So we need to find out which one of these puts is better matchup because of the put skew to go along with our at the money call. And that's what we're testing. And if it proves that, hey, by the end of the day, both the at the monies are actually offsetting each other perfectly, then that's what we'll do. But you can see these out of the money options right here. This one here is an out of the money. Oh, well, we got one that's in the money and we got one that's out of the money, don't we? So we got one that's 53.10. And we got another one at 52.90. 52.90. That's this one down here. You know, in the olden days, we used to have tall monitors. We used to have monitors that were tall like this. Can you see my hands? We had tall monitors. And then they wanted to watch movies on their computer screen, so they made monitors wide. Wide monitors are not nearly as good, in my opinion, as tall, skinny monitors. I wish we could take it. I know some guys, you can take some of these monitors and turn them sideways. That'd be nice to have a wide monitor and a tall monitor and have one of each. I think I'm going to work on trying to do that. See if I can make that happen. Because then I can have my charts stacked on top of each other. That's the way I like them. But if you stack them here, they get so skinny and long, that's worthless. You can't stack monitor. You need to turn your monitor and have stacked charts all down like that with your accounting at the bottom. That would be optimal. Oh, that would be nice. Beautiful. I would love to find a big, long, tall monitor. I don't like these wide monitors. I'm not watching a movie. I'm trying to work. Who writes a letter on a piece of paper on the side? Nobody writes letters on the side. We all write letters like this. Whoever come up with it, it's just people who want to watch movies. I think it's the porn industry. They just want to watch their porn on a widescreen. That's how come we have widescreen monitors nowadays instead of tall, skinny monitors, which makes a lot more logical sense. Logic. All right. Do you think I'm going to have to confess to YouTube? They're going to get mad at me for saying porn. I have to go tell them everything I do that's not. I'm going to have to go confess to them that I said porn. They might ban this video because I said porn. I don't know. Okay, look what's happening over here now. The at the monies are actually doing pretty much the best, aren't they? They're maintaining what we want. What's the goal here, lad? Ask me. What's the goal? The goal is we don't want those things to make or lose any money. That insurance policy is supposed to be pretty much, neutral. That's the idea. It's supposed to gain money if it breaks out and goes for a long position. But we're half hedged. Remember, these are a delta 0.50 and our contract is a delta 1.0. So it's only doing half. But by the end of the day, it'll be closer to delta 1.0. That's why it does a better job of after a period of time that it does that for you. It'll protect you better. But I'm trying to find out which one protects you better in here. So some of these are getting really crazy now. Let's do last again. Okay, so 112 loss on the at the monies, 62 on the out of the money in the monies. So the one that's making us money right now because the market's on a rise is the buy put. So we bought a put and it's making 12.50. That doesn't make sense because the market's rising. If you buy a put, you make money when the market goes down. But that is a 52.90 put, and that's the lowest one, 52.90. That's this one. Why in the heck is that one making money? Well, it says right there it's losing $62. You got to go back to price. Oh, so okay, there's where it's losing $50. Oh, 37. There it is. Okay, you can see the numbers up here on the screen too. Forgot. You can see them up here. 32, 75, 25, 77, 30. These are the ones we sold. These are the ones we bought. These are insurance policies right here at the money. And then we got one strike away on both sides. I'm going to just let them go. And at the end of the day, we'll see if this put skew makes a difference or not. Which one holds true for us? So our sold options are up $40. So that's the ones we're making money on. So we want these to lose money as little as possible. So that's why we kind of want them to match up if we can. Right now, the ones that are at the money are the ones that are matching up the best. $50 loss, $50 win, 0. Insurance policy, 0. That's what we want. But if the market goes to the moon, we want to have better insurance. All right. Just trying to find out if the put skew is going to mess with us. But look at the difference here. These options here, and they're only one strike out of the money. And we're down $200 on those options. So the at the monies are performing way better here in the beginning, aren't they? Both of them right on top of each other. $50, $60, $50, $60. They're doing really good. Of course, that the market's not right at them either. So there's your put skew. There's a little bit of a put skew in there. Market's going up, but the skew is off because that should be exactly matched only if they're right exactly dead center on that green line right there at 5,300. So as the market rises, see the call option should be making more money than the put option is losing. And it's not. And that's the problem. That's what I want to test. That's what this is a strategy test for. All right, we got Queen of All Trades popping in here. Queen of all trades coming in here and saying hello. It's great to see you. Great to have you. I haven't seen that beautiful little icon on here before, so it's great to have you. Come and join us. What we're doing today is we're looking at the options put spread skew. All right, because we like to put on 0 days till expiration straddles. Yes, straddles. So we like to sell straddles at the money with the 0 days till expiration. But then we have to protect them with insurance or with a hedge. And we've been doing all kinds of testing to find out what's the best way to protect ourselves. And we use at the money options, and we've been going through tests where we've been putting lots of theta, 30 days out theta, see how small of decay we can get. We've been doing very short theta. We can't do 0 days to expiration because if you do a 0 days to a 0 days, it'll just close the position out, right? We don't want to do that. So we have to have longer days. It's called a calendar straddle. A calendar straddle. So we put a calendar straddle on top of a sold straddle, and then we have to determine which data or which delta and which theta. And we've been just running lots of tests to test and find out what the best theta and what the best delta is. Now, the theta we want to be very short, because then it's much more sensitive to price movement, because these are in the insurance policies that are protecting us. They need to be sensitive to price data, price move. That's why a shorter theta is good. But if you get it too short, then the theta decays too quickly, and then you lose a lot of money. So we don't want to do that either. So we're buying about kind of the happy medium, somewhere out there around 4 or 5 days of theta, so that the market doesn't decay very fast beginning, but it's short enough time frame that it's very sensitive to the price movement, so it will continue to protect us. All right, so that's that happy medium, somewhere around 4 or 5 days, 3 to 5 days. So that's the best, and at the money is the best. Now, they're the most expensive, but that's okay, because you're going to get most of that money back, because we're not going to let them go, obviously, 3 to 4 days. We're just going to take them off at the end of the day when we take off our 0 days till expiration sold straddle. So we tried going out of the money. So we tried doing Delta 20, right? Well, that's very inexpensive, and that's wonderful, because you have very little time decay, or very little data decay, but they do you no good if the market takes off and runs. So those are kind of like, okay, well, we could do those, but if the market moves at all, has any kind of a move during the day, then it doesn't do you any good. They're not insurance policies. All they're going to do is reduce the requirement for your margin. Brings your margin down from like what, 12,000 to like 1,000 or something. So that's good if that's all you're looking for. But if you're looking for a hedge, if you're looking for some sort of insurance policy to help you, this little calendar project that we're working on here is a good way of doing that. That way you still get your same margin drop, but you also get some hedging protection. And we're just trying to test that. We're just trying to see which ones of these gives us the best hedging protection. And we've decided that the at the monies are doing us the best. And we've tested all different time frames on the theta, and it comes out to be about 5 days, 3 to 5 days. That's what we like the best. All right. And all this is documented in Pit News Magazine. For those of you who weren't here earlier, Pit News Magazine is coming out today. And so Pit News Magazine is our club magazine, and you go get a copy of it over at pitnews.com. You can get one full year for $49.95, but the first 3 months are only $1. So you can pay $1, get 3 issues, get all this work that we've done on this wild eye, crazy eye, iron butterfly, all the research for it, and you can see how that works, and get that at Pit News Magazine. Just go over there, subscribe, $1 for 3 months. If you don't like it, cancel. There's no long-term commitment. You paid $1, you got 3 issues. Try it out. If you like it and you love it, then you're going to get Pit News Magazine for $1. And then if you keep it for another year, it's only $49 for an entire year after that. So the club magazine is where we do all of our research. It's a lot of fun. Everybody really loves Pit News Magazine. And so jump over there and look at this. Look at this. So we're making $50 on our solds already. And we're at break even on our insurance policy, which is good. That's at the money. Look at this one here, the skew on this one. Down $250. This one's down $170. Now, remember, we don't need all of these. When we do this for real in our real money account, we don't put all these on. This is just a test. We're comparing this one against this one against this one. That's all we're doing. Okay, we're comparing them. And then when we actually do this with real money, because this is a demo account, right? That's what you do in demo accounts. You test things. So when we do this with real money, we won't put all 3 of these on. We'll just pick the one that turns out to be the best one to put on. Is it this one? Is it this one? Is it this one? Is it this one? Or is it this one? And it's looking to be at the money. It's looking to be this one here so far, right here in the beginning. But we're going to test and see. By the end of the day, we may have some wildly different. See, now here's the put skew. So see that put? But we bought a put, and it's down 100. We bought a call, it's up 137, and the market's rallying. So that's exactly what we want to see. That's exactly what we want to see. We want to see that call making more money than the put is losing, because that's our insurance policy, and it's got to make insurance against that put option and into other option, because the we bought this, so the maximum amount of money that we can lose on this side is the premium we paid for it, right? We paid $1,400 for it, but we've also got 4 days of time value in there, so they're not going to decay that thing down $1,400 just today, because they got 3 more days they got to cover our insurance policy for. So that should decay very slowly, that put option, but the call option should increase more quickly. And that's the game we're playing. Now, we can double up on our insurance. We can come in here and say, look, excuse me, we have a delta 0.50. We could buy 2 calls and 2 puts and have a more perfect hedge, right? We call that a perfect hedge, because now you have a delta 1, a 1.0, and a delta 1.0. By the end of the day, you're going to have twice the cost of insurance, because you're way overinsured, right? Because you're going to have, but you're not going to have a full 1-to-1 delta ratio. So that's another thing we need to test, right? If the market really moves, you would want to have that extra insurance on there. If the market doesn't move, it's in just a quiet, dead market all day, you don't want that extra insurance. It's the same thing. If you're not going to drive your car, then you don't need a lot of insurance. But if you're going to go on a big, long road trip all the way across the country, you better have some really good insurance. The odds are that you're going to have a wreck if you're going to drive from here to New York City, a lot more than if you're just going to drive from here to the grocery store. Actually, maybe not. If you live in this town, you drive to the grocery store, it's probably more dangerous than driving to New York City. I don't know. The town's been pretty crazy lately with all the traffic. All right, so there's our wild eye, crazy eye. We're just going to let that thing go. It looks like here in the beginning, I'm going to have to document that in the beginning, when we first started out, that the at the moneys were the best. This one here is performing admirably against our position here, because we sold the call and we bought a call. We're losing 67 and we're making 137. And that's exactly what we want to see. We want to see the call covering the loss of the sold call. We got the put, which is we bought the put and it's losing 100, but on the sold put, we're making 160. So, hey, it's working, right? These are not working for us. These down here, not working for us so much. So that's a very important thing that I wanted to test, and we're learning here. All right, let's bring this down. The Russell, the NASDAQ. We didn't do much day trading today. We were more focused on our wild eye, crazy eye. And one of the things I wanted to show you guys, another thing that's in the Pit News magazine, but I wanted to bring out this this chart here for you, if I can find it. I'm going to bring this up here onto the screen for you so you can see what I'm looking for. I'm looking for the chart. Here we go, right here. See this? This right here. This one right here. That's what I want to show you. Okay, this is one side. This is a short call. So we sold a write a call option. If you buy a call option and the market, let's see. We got you still on there, Queens of all trades. Let's take that off so you can see. So this is a short call option. All right. So if you buy a call option, you want the market to go up. If you sell a call option, you want the market to go down. Right. That's how you make money. Now, if you buy a call option, the maximum amount of money that you can make is the amount of money, or you have an unlimited profit potential, right? If you buy a call option and the market goes up, you have unlimited profit potential. The maximum amount of money you can lose is the premium you paid for the option. So if we pay $500 for the option, well, that's our stop, right? It's built in. It's the maximum amount of money that we can lose over the period of the time of the option that we bought the option for. So if we bought a 30-day option, well, we have 30 days for it to lose $500. Now, it's not going to lose all $500 on the very first day, because it's got to cover that for the whole month. So the time decay will be a little bit shorter, right? Smaller at the beginning and bigger at the end. And so this is a sold option. So what I want to do is I want to show you, when you sell an option, this is your cone of probability. And I generally will draw that on the chart. And you can see that even if you sell it right here at the money, this is where you sell it at the money, right where the market's currently trading. If the market goes against your position, towards the end of the day, you still got a little buffer in there of where you can make some money. All right. Even though the market goes against your position, you still make a little bit of money. If it goes up hard, well, this is where you lose money, up in this region here. But if it drops, goes down in here, this is where you start making money. And at the end of the day, you make your max profit. Anything below the line is max profit. So it's going to expire worthless and you get the full premium of what you sold it for. So if you sold it for $500 and it's a 0 days till expiration, at the end of 0 days, at the end of the day, you're going to get your $500 as long as it's below that line. All right. So that's pretty cool, right? But you have to be right. You have to make sure that you know the market's going to fall. Well, oftentimes we don't know whether the market's going to fall or rise. So we might put on either a put or a call. If you put on a put, it goes just the other direction, right? It goes this way. So then you got the red zone below and you got the green zone above. But if you put them both on, let's put on a put and a call, that's when we get this view here. This is what we call the sold iron butterfly, or a wild eye, crazy eye iron butterfly, if you start messing around with the theta like we do. So if you come in here, you can see that you're going to lose some on one and you're going to make all on the other, or you're going to, make all on one and lose some on the other. It depends on which direction it goes, which is why you get that little cone of probability. You have to think about these things on an individual point of view. That's why when I trade options, I like to say that I trade options on the S&P, or I trade the S&P with options. I don't trade S&P 500 options. I trade the S&P 500 with options. There's a difference. I know it's a small difference, but it's the difference that makes the difference between what we do in our strategies versus what most other people are doing out on the internet. When you go out and you look at YouTube and you find 10,000 people who are doing this, what you think is the same thing, it's not. It's all logic of how we're thinking about this and how we work and manage our positions, because we are trading the S&P 500 with options. We're not trading S&P 500 options. I know it's a small difference, but it makes all the difference in the world, because when we trade, we want to look at each individual option independently and know what the profit and loss statements are for each independent one. And then when we put the second one on, we want to know what that one is independent. And then we want to know how those two fit together, because when those two fit together, that's what makes what I call our puzzle piece. And this is why our strategy looks like this. This is the wild eye, crazy eye, iron butterfly. This is our short straddle, and this is our long strangle. And this is where you end up with what I call a puzzle piece. Combining the short 0 DTE straddle with the long 30 days till expiration strangle, profit and loss graph reveals a striking overlap of a profit and loss zone, fitting the two together like a puzzle piece, showcasing the potential synergy between these two strategies. While the short straddle profit covers the loss zone of the long strangle, combining this approach offers a balanced risk profile with limited loss potential, highlighting the effectiveness of this strategy. And so that's what you're seeing there. See how this one here, if you just did the long strangle, you end up with a loss zone in here. If you do just the short strangle, well, you only have a very small profit zone. But if you do both of them and lay them over the top of each other, look how they fit together like a puzzle. The short straddle has the profit zone right where the long strangle has a loss zone. That's why we do them together. All right. But you can't do them on the same ticket because they have different time frames. You have to play with the theta. And that's what we're doing over here on this test zone over here. And all this, again, it's all laid out for you in Pit News Magazine. So I've got it all in Pit News Magazine, this month's article. All right. Oh, wow. Look at the Dow. It's flushing down. We could have traded that. Of course, we had one arrow down and it failed. We had another arrow down and it failed. Then it was the third arrow that took off and dropped like a rock. How about that? That was nice. Nice little flush there. All right, we're right back to the VWAP once again. That VWAP is like a rubber band. It's like a magnet. It pulls the market to it. It likes to pull the market to that magnet, which is why we wanted to put our option strategy on when it crossed that VWAP. Now, we put it on a little late down here. We got in, it was a little bit below the VWAP when we put it on. But see how it came right back to the VWAP once again. And since this is a neutral option strategy, that's why we like to have it at the VWAP, because the VWAP is like a magnet and it'll pull the market back to that price. All right, guys, we're up $335, it says. Let's go take a look what we're doing here. Some of our insurance policies are starting to come back for us. They were down pretty bad there at first. Let's bring this full screen. Now, we can't really count the profit of this one, $37.50, and we can't really count the losses of this one, $87.50. That's not really fair because these are just our test puts, right? Now, the idea is that we're going to pick the best one out of them, and that's what we're going to do tomorrow or from here on out. Or, well, we got to test it more than once. One time is not a test. But what is performing admirably is our at the monies. Look at that. Those are the ones that are actually doing the best. And that's the ones we've been doing, but I wanted to test that put skew because sometimes the skew gets off a little bit. And it looks like the at the monies are better than the 1 click out of the money or the 2 clicks out of the money. The 2 clicks out of the money is not doing bad. Look at that, 37.50. But the 1 click out of the money, it's just down 87 right now. It just depends on where the market's at, right? Again, we're trading the S&P 500 with options. We're not trading S&P 500 options. So we do our due diligence, we do our technical analysis, we watch where the market's going to go, and it depends on where the market moves. Is going to depend on whether these strategies make money or not. And if we have to, we may have to roll, or we may have to dollar cost average. We may have to put on another insurance policy. That's the name of the game, right? If we think the market's going to move, it's going to be a big moving day, we might want to put on an extra insurance policy. But our insurance, this is the cost base, $975. We're going to make $975 against our insurance policy that we have to pay for. But we're not going to pay $2,862 because, again, it's got 4 days till expiration, and it's going to hold on to its premium very tightly here in the beginning. So we don't have to worry about that. It's going to be the movement of the market, the sensitivity of the movement of the market that's going to make those things valuable. Now, look, the $200 is in our favor. The put, the buy the put. Now, this is the problem. This is the problem that we run into. When the market falls, the put option makes a lot of money, and that's good, right? The call option loses very little money, which is good too. We don't want to have to pay a lot of losses, and we like to make a lot of money. But when it goes in reverse, when the market takes off and goes to the long side, which in the S&P 500, it goes long much more than it goes short. So it goes to the long side. The call option does not make as much money as the put option loses. It doesn't do this in reverse. That's why the put skew is important. We need a put option that makes more money when the market rises than the call option loses. So look at this put here. That one's making $200. Of course, the market's falling. The reason we're making all this money is because we bought all these puts. We bought a put, bought a put, bought a put. We got all these puts. So if the market falls, we're going to show a whole big lot of money. Look at this. We bought all these puts out here. Like $337 we're up on those puts. Take it money. Take the money. No, that's not what we're testing here. We're not just trying to take some profits. We're trying to learn. This is a learning environment. So we're up 200 on this one. We're down 87.50 on that one. Is that what we want to see? It is. We want to see the put option pay for the call option and pay for the loss of the put option here. So that's what we're seeing. So this needs to pay for this one, and this needs to pay for that one. And that's what's going on. So we got the sold put, the buy put. The buy put needs to pay for the losses on the sold put, and the buy call needs to pay for the losses on the sold call. And it's working perfectly here. This one's making all kinds of money. These out of the monies are doing well. Of course, that's because they're both put options. But they're making 200. How much is this one making? 162. This is a 53.10. So the 53.10 is the one that's way up there. That one was the one that was in the money. It's up $200 because the delta's higher. It has a higher delta. See, it's a 0.56 on the delta. This one has a 0.45 on the delta. So that's why it's only making 137.50 because it's out of the money. This is in the money. These two are just one click out of the money. They're not doing anything. So the market's dead center of these two. That's why they're not doing anything. But look at the skew on this. 162 versus 87. 157 versus 165. So that's why we're making 750 on here and making 75 up here. Man, those out of the money puts are really making some money. The market's falling. All right, guys, I'm going to let you go. We're going to let this run the rest of the day. I'll take some screenshots throughout the day, and tomorrow morning I will come back and let you see what happened and show you how they turn out. And I do have a Sunday school lesson for you today. Let me come in here and give you a little Sunday school lesson. I always like to end with a Sunday school lesson if we have time. So plan your trade and trade your plan. Trade with the retail trading crowd. This is a Me Too market, all right? A Me Too market means that you want to look for high volume and high open interest, especially on options. You want to be where everybody else is trading. Now, in the futures market, we have contracts that end, they expire, and so they roll from month to month. You notice up here, this is the June S&P 500. Well, what does that mean? Well, that means at the end of June, close to the end of June, it's going to expire, and you're going to have to roll over into the July, September. Now, that's not just for options. That's for contracts themselves. The options have expiration dates as well. So you're dealing with two expiration dates. The contract of the underlying contract itself is going to expire, and you got expiration dates on the option. So it complicates it a little bit. That's why fewer people trade over here, but that's why there's greater opportunity over here. Fewer people trade it because it has a little bit more complication to it, but you have these two expiration days that you have to deal with. All right. So, I want to show you that up here in the left-hand corner. See that where it says July or June? This is the June S&P 500. So you want to be where the action is. Where how can I get there? There we go. So you want to be where the action is. Go to the volume and open interest. And so in the futures market, you have to always be looking at, is it the June or the July contract or the August? Which contract is it that everybody's at? You just look at the volume at the bottom of the chart. Again, over here, it'll show you. Just look at the volume. See the volume right here? Is the volume. You want to find the chart that's got the highest volume, and then the highest S&P volume, and that's the one you want to trade. All right. You always want to. Generally, it's the front month, the one that's going to expire the soonest. So that's what we do there. All right. So you want to be a Me Too crowd. Trade with the crowd. Look for the volume, the open interest. Don't be a cipher. Trade where everyone else is trading. Volume and open interest is your friend. Small caps, when you're trading stocks, generally where you'll find your friends over in the stock market. Not that we don't like to trade large caps. We do. We like to trade large caps because they have good options on them and lots of volume and open interest on the options. So if you're going to trade options over in the stock market, we generally want to do the large cap stocks. But if you're just going to trade the shares, you're going to find a lot of your friends, a lot of the small traders, small speculators down in the small caps. So kind of keep that in mind. A lot of the small caps don't have options, and when they do, they're very thinly traded. So be very careful if you're going to use options on the stock market in small caps. All right. And we didn't have time to go over and look at our options trades today. We'll try and do that another day, maybe tomorrow. But I do want to talk to you about married puts. So tomorrow, bring your engagement rings because we're going to get married. We're going to marry some puts tomorrow. All right. So take care, and we'll learn married puts tomorrow. We'll see you tomorrow. Have a good day. Oh, and if you like today's class, if this was helpful for you, please ring that bell. Please hit that little thumbs up. It always helps. And we get more people in here. It's always fun to have a good crowd. We've got a nice crowd today. We've got a lot of people saying hello. So it's good to have you. And give us a thumbs up. Subscribe so you can come and join us every morning as we test and we work. We try to help ourselves make more money. All right, guys. We will see you tomorrow.